Good morning, everyone, and happy Monday. This is Rob McDougall with Zhang Financial with your weekly economic update. Today is Monday, December 12th, 2022. Last week we had, let's call it, 4 significant economic releases. We'll go over each of those, talk about how the market performed, and then talk about releases that will occur this week. So last week, in terms of economic data, the first piece of information we got was on Monday, the November ISM non-manufacturing or services index, very strong and much better than expected. So it had a down. This indicator was down significantly in October from the September level, but rebounded almost back to where it was in September. Came in at 56.5. versus the consensus at 53.5. So again, for services, they seem to be doing very well throughout this entire year. On Friday, then, we got some inflation numbers, the producer price index, the November producer price index to be specific. The actual number on that was a little bit disappointing. So we've been calling, of course, for inflation to be rolling over and fairly aggressively over the next year. This data point was slightly negative in that the actual year-over-year November producer price index was up 7.4%. The expectation had been for a positive 7.2%, so it missed that a little bit. As well, the core PPI, that was up 6.2% year-over-year versus the consensus expectations of positive 5.9%. Now, you would think this would be negative in terms of inflation expectations, but surprisingly, inflation expectations in the aggregate fell last week. So we follow the 10-year break-even, 10-year Treasury yield minus 10-year tips. That fell to 2.26% at the end of the last week, Friday. That was down 11 basis points from the prior week. So expectations for inflation for the next 10 years by bond market participants in aggregate is 2.26% as of Friday. Now, why would that number come down despite the fact that the PPI indicators, core and otherwise, were up higher than expected? I think it really has to do with the oil market. So if you've not been keeping track, and you probably do see this at the pump, oil prices definitely have been coming down, probably more aggressively than you've noticed, at the pump at least, over the last month. WTI, West Texas Intermediate, was at $92 on November 9th. That fell to almost $70 last week. It's rebounded a little bit. Today it's 73 and change. But again, it's dropped from $92 a barrel to about 74, less than 74 right now. So over a 20% decrease in the last month. So I think that is driving some of the lower expectations for inflation. Lastly, from last week, we had the University of Michigan Consumer Sentiment Index for December. It came out on Friday. That was also positive. So the expectation was a slight increase from November. November was 56.8. The expectation was it would nudge up to 57 flat. It came in at 59.1. So that's another good data point for the U.S. consumer and expectations. So last week with those mixed numbers, I would say, how did the market do? Actually pretty poorly, both in terms of equity and fixed income. I think a lot of the expectations were, or the feeling for the market was that the market maybe was a little bit overbought in the short term. I say that because the S&P 500 quarter to date, so since October 1st through the end of last week, was still up almost 12%, 11.89%. So it's been a really strong fourth quarter. If you haven't noticed, again, numbers are negative for the full year, but things have rebounded sharply. But last week, the equity indexes and fixed income indexes gave a little bit back. So last week, S&P 500 down 3.35%. Below that, as we often do, we take a look at the growth versus value. Another good relative week for value. Growth last week in the U.S. down 4.65%. Value down 3.13%. So year to date, value has outperformed growth by over 34%. It's good for our client portfolios, obviously. We do bias our portfolios towards the value component. International markets were actually nearly flat last week, so did better than the U.S. markets. And the real driver there, China up 6.8%. And that's a bit of a relief rally because China's down 22% year to date. But it's been rallying, I think, largely because of COVID restrictions that are definitely easing at this point. So in terms of returns, the last thing, fixed income down a little bit last week. The aggregate bond index down nearly 0.5%. We had the 2-year yield rising 5 basis points, the 10-year yield rising 6 basis points. So again, in fixed income, we've also had a very strong rally on a quarter-to-date basis, but we gave up a little bit of that last week. So this week, what do we have coming up? We've got some inflation numbers. The biggest item this week will be on Wednesday, the Federal Open Market Committee rate decision. Lastly, on Thursday, we have retail sales. So tomorrow, Tuesday, we have the November Consumer Price Index, the CPI. Again, we think inflation should be coming down fairly aggressively in the next year. It's come in spurts, I would say, over the last few quarters. Now, back in June, the CPI hit its peak at 9.1%. October came in at 7.7%. So it's been nicely down. We would expect that to drop further this month. So the consensus expectations, again, it was 7.7% end of October. For November, it's expected to be 7.3% year over year. When we look at the CPI core, that's CPI minus food and energy, again, the expectation is another drop this month. It was 6.3% last month, expected to drop to 6.1%. So on Wednesday, I mentioned the Federal Open Market Committee will be meeting. They actually start meeting tomorrow, Tuesday, but they will have their rate decision on Wednesday. Expectation, this is kind of surprising. I would have expected this to move a little bit higher. The expectation is the Federal Reserve will increase the Fed funds rate by 50 basis points, 75% probability, but there's still a 25% probability built into the Fed funds future market that they'll raise 75 basis points. I'd be very surprised if they did that. That'd be a very huge signaling mechanism to the market, probably would not be well received. Also want to mention the next Fed meeting after the one tomorrow and Wednesday, February 1st is the next rate increase decision. And now the expectations are with about an 88% probability that from today until February 1st, the expectation between these two meetings is that we will have a 100 basis point increase in the Fed funds rate from the current target of 375 to 400 basis points. So 88% probability built in that we'll have 100. So if we get 50 on Wednesday, expectation is very strong that we'll have another 50 basis point increase on that February 1st meeting. On Thursday, while the November retail sales, the consensus there is actually for a decrease. So a decrease of 0.1%, but that is coming off a strong October, which was a positive 1.3%. And the consensus on a core level, or I should say retail sales minus auto, is the consensus is a small increase for the month of November, up 0.2%. And again, last month, retail sales ex auto were positive 1.3%. So last thing to mention here is the Atlanta Federal Reserve, their fourth quarter GDP estimate. Again, clearly we're far from any recession at this point. Could happen next year, possibly, sure. But right now, the U.S. economy is actually pretty strong. In fact, the Atlanta Federal Reserve took up their expectation last week. They now expect fourth quarter GDP growth in the U.S. to be up 3.2%. Last week, that indicator, or the week before, it was 2.8%. So they took up their expectation. So clearly, I think things are fairly strong here in the U.S. from an economic standpoint. And the biggest concern overall is inflation / how aggressive the Fed is in increasing rates. So that is it for the economic data last week, this week, and the market returns from last week. Thank you very much for watching. We'll look forward to seeing you next week.